So we left off our discussion today in class where we were discussing how much you can afford. So we went through our scenario on determining how much you can afford in terms of purchasing a house. And then we went through the steps of, qualifying for a loan and what are the numbers and the like. So what we want to talk about now is how do you go about the process of finding the right home? So what are some things you need to take into consideration? First off, you need to take into consideration the size and style of the home. And this does affect the affordability and is based on the needs of the individuals. So, for instance, as you get older, you may want to think about homes that are maybe all one level, whereas younger people maybe looking to grow a family might think about a two-floor house where the family and the bedrooms are upstairs and the kitchen and family room are downstairs. So those are all things to take into consideration. As you get older, you might look at a smaller yard. When you're younger and you might have kids that want to play, you might want to look at a bigger yard. These are all things to take into consideration. Then you also want to take into consideration the location. Do you want to consider the geographic area, the different communities, and all of those things will affect that equity value that we talked about earlier and that I sent you an illustration of in another YouTube clip. So location is a very important factor. How close are you to work? How close are you to stores and shopping? And maybe if you like the outdoors, maybe how close you are to things of that sort. Then you're going to look at the actual cost of the home itself. Is the home within your budget? And that we discussed in class as well. We look at as benchmarks 2.5 times your gross annual income, as well as we look at and take into consideration the not having a mortgage that represents greater than 20% of your gross monthly income and does not exceed 36% of your overall income in terms of your total loan calculations, your mortgage, and everything else. Then we have to look at, well, what is the interest rate on that mortgage that we're going to get? Obviously, the higher the interest rate, the more it eats into what you can actually afford. So you want to try to purchase a home getting the lowest interest rate possible. Sometimes you have to pay these fees that are called points. And all that is just basically upfront money that the lender is going to require in order to give you a certain rate. So that's another factor in your mortgage costs. And then lastly, to add to our costs, our upfront costs, we have a thing called closing costs. And these are costs that are paid at the time of closing on the house. Closing is when everybody comes together and actually, settles up the bills between the bank and the seller and any other parties. Maybe the taxing authorities, maybe property taxes need to be settled between the old homeowner and the new homeowner, and any fees for searches or title work that might have been done, or insurance or mortgage processing, etc. These are all called closing costs, and they add to the upfront cost of your home, anywhere from 2 to 6% of the actual purchase price, and that's in addition to the down payment. So when we were discussing how much the down payment was, earlier, we had said that if we had a $100,000 home that we were looking to purchase and we were going to put down 20%, that was our initial equity, 20%, so then the down payment would be $20,000. So in addition to that $20,000, you would need another 2 to 6%, which would be anywhere from $2,000 to $6,000 as closing costs. So at this point, then you're up to basically an upfront investment to buy your home of $26,000. Then, of course, you need to make sure you can afford that monthly payment, and that's, as we had mentioned earlier in class, where you're going to be required to have your mortgage not be any more than 28% of your gross monthly income. And then lastly, you need to make sure that you can afford whatever the maintenance costs on your home. Obviously, newer homes have lower initial maintenance costs, but you might have more upfront in terms of decorating. Maybe you have to do window treatments, or maybe you don't want all the walls to be white. Typically, unless you pay the builder extra, most of your walls are going to be white or some sort of cream color. But then on the flip side, older homes might have higher initial maintenance costs. Maybe you have to replace the furnace, or maybe you have to replace the roof. So you have to weigh those things out and figure out which is better, higher maintenance costs or more in terms of decorating costs. So then the actual home buying process. First thing in the home buying process, we're going to contract to buy the house, and we're going to do that through what we call a purchase and sale agreement. This is where we make the offer to the seller. If we're the buyer, we make an offer to the seller, and if the seller accepts our verbal offer, then we make a purchase and sale contract, purchase and sale agreement, which makes that verbal agreement into a contractually binding purchase and sale agreement for that house. That does not mean the house is sold yet. We have not finished the steps, so let's continue on here. Then you apply for your mortgage. You go to the bank or other lender, and you get, hopefully you get approved for your loan, and you get a mortgage. The mortgage is actually the lien against the property until the loan is repaid, and it basically secures the bank's interest in the property in the event the loan is not repaid. And there are a variety of different mortgage types, but the two primary types are fixed rate and adjustable rate. Fixed rate is the most common, and the payment stays the same over the life of the mortgage. So you pay, a fixed dollar amount month after month after month for the entire term of the loan. Whereas you can also get what we call an adjustable rate loan. And this is basically where the interest portion changes over time. And so therefore, because the interest rate changes, it affects what the actual mortgage payment will be. Sometimes most of the time there is some sort of cap in it, but over a year period of time, like the interest rate couldn't raise more than, say, 2 percentage points in a year. And that's primarily to protect the borrower. But if you think about it, if you went into a mortgage and found out that went into a mortgage and you anticipated that you were going to be paying $300 a month, and then all of a sudden it jumped up, and now you're paying, say, $400 or $450 a month, and if your salary hasn't increased by that amount of money, which oftentimes it does not, then all of a sudden you're paying a lot higher money out of pocket than maybe you can afford. And sometimes the banks, when they sell you on an adjustable rate loan, try to convince you to get that so you can get into that house. So your initial payments might be lower, but then the interest rates go up, and then you're in a pretty desperate situation at that point. At that point, it's pretty desperate. You are worried that you might actually lose or default on your loan because maybe you can't afford that interest rate increase. Any of these, whenever you apply for a mortgage, it requires credit approval, and that credit approval is based on your income level, whatever you're making at the time, the amount of your down payment. The higher the down payment, the better chances of getting approved, and it's also based on your credit rating history. So how well you've repaid all of your other types of financial obligations over time. So that's a very important factor. Even things such as your payments on your utility bills or your cell phone, all of those types of things can influence your credit rating, your credit score, and whether or not you can get a mortgage and a mortgage at a good and desirable interest rate. Then you go to the closing, which is the process where all the parties come together. That's where the seller comes and the buyer comes, and the bank or the finance company comes together with everybody's attorneys, and they go through the process of transferring the deed and ownership of the property from the grantor, the seller, to the grantee, the buyer. And this is where we sign all of the mortgage documents, and all of those closing cost fees are paid. Okay, and that is it, I believe, for our notes for buying a home. So if you have any questions, please let me know. And in the meantime, have a great night, and we'll talk to you later.